For more than a decade now, the world of digital assets has pretty much felt like the Wild West, a thrilling but really chaotic frontier. But it looks like the sheriff is finally in town, and they're writing the rulebook. So in this explainer, we're going to dive into the US government's big plan to bring some order to the world of crypto.
But to really get where we're going, you got to remember where this whole thing started. See, back in 2008, the mysterious creator of Bitcoin, Satoshi Nakamoto, put out this paper with a vision that basically questioned the entire foundation of modern finance. The goal? A system that didn't need you to trust big banks or institutions. And man, that idea, it lit a fire that grew into the multi-trillion-dollar industry we see today.
All right, so let's explore this new frontier. First, we'll look at the core tech that makes it all possible, and then we'll meet the pioneers, the speculators, and the builders who are actually living in this new digital world.
So, the engine behind this whole revolution is the blockchain. The easiest way to think about it is like a public, digital receipt book that isn't owned by any one person or company. Every single transaction is a block of data, and it gets chained to the one that came before it. Now, this chain is copied and spread out across thousands of computers all over the world, which makes it incredibly hard to cheat or tamper with. It's the tech that lets us have a system based on math we can all verify instead of just, trust.
In this ecosystem, it's filled with all kinds of different players. First, you've got the issuers. These are the creators, the people launching new tokens and projects. Then you have the retail participants. That's everyday people, really. They were the early adopters and a huge force behind the market's explosive growth. And now, the big one, institutional investors. We're talking Wall Street firms, hedge funds, venture capitalists, and they are bringing some serious money to the table.
But when a frontier expands at lightning speed with almost no rules, you're going to have some growing pains. And in this case, some of those pains were absolutely catastrophic. They revealed some deep, serious problems that just couldn't be ignored anymore.
And the most obvious example, of course, was the spectacular collapse of the crypto exchange FTX. See, this wasn't just one company failing, it was a contagion, a sickness that spread. Its meltdown sent these massive shockwaves through the entire industry, wiping out billions of dollars in customer money and just laying bare the huge risks of an unregulated market.
So, events like FTX forced regulators to get really serious and figure out what the key risks actually were. Number one, a total lack of basic consumer and investor protection. Number two, real threats to market integrity and maybe even the stability of the whole financial system. And number three, illicit finance. The risk that these new tools could be used for things like money laundering, dodging sanctions, and other big threats to national security.
Now this slide right here, this shows the moment the game completely changed. When the SEC finally approved Bitcoin ETFs in early 2024, the floodgates just blew open. You can see it right there. Billions of dollars in institutional money poured in almost overnight. And that right there instantly changed crypto from a kind of niche hobby into a major league part of mainstream finance, which made the need for clear rules absolutely urgent.
And that brings us to the government's response. The White House report that we're looking at is really the first big, comprehensive attempt to create a rulebook for this new world. And the stated goals are to protect consumers, sure, but also to strengthen American leadership in financial tech.
To get their arms around something this massive and complex, the government's whole strategy can really be boiled down to 3 core steps. It's pretty logical. First, you have to define what these things actually are. Second, based on that definition, you got to clarify which government agency is in charge. And then finally, you can actually set the rules for how they're traded and held and used.
Okay, let's start with step 1, which is maybe the most fundamental question of all. What is a digital asset? I mean, is it a stock? Is it a currency? Is it a commodity, like gold or oil? The answer isn't just some academic debate. It literally determines everything that comes next.
And this brings us to the biggest tug-of-war in all of crypto regulation, the fight over whether a token is a security or a commodity. An asset is a security if it passes something called the Howey test, which basically asks, are you investing money in a project expecting to profit from the work of others? If so, that's the SEC's turf. But if a token acts more like a utility or a digital raw material, like Bitcoin, especially once its network is decentralized enough, then it's treated like a commodity, and that's the CFTC's yard. This distinction is the battleground where so much of this regulatory fight is happening right now.
So once an asset is defined, we know which watchdog is on the beat. The SEC, they handle the securities. The CFTC oversees commodities. The Treasury Department, through its agencies FinCEN and OFAC, is laser-focused on fighting financial crime. And then you've got the federal banking regulators, the Fed, the FDIC. They're in charge of making sure any bank that starts touching crypto does it safely.
Okay, so we've got the players and we've got the referees. Now let's talk about actually building the stadium. How does the government plan to create a secure bridge between this fast-moving world of crypto and the bedrock of traditional banking?
For a long time, banks were really hesitant to get involved with crypto because, honestly, the regulatory waters were just so murky. The White House report even admits there was this perception that regulators were basically closed for business. So the goal of this new framework is to change all that, to provide some much-needed clarity so that banks can finally start offering crypto services without being afraid of a sudden regulatory smackdown.
Now, a huge part of this integration revolves around stablecoins. You can think of them simply as digital dollars, tokens that are designed to hold a steady value because they're backed by real-world currency. Regulators see them as a massive opportunity to upgrade our financial plumbing. I mean, imagine sending money across the globe as easily and as quickly as sending an email with way lower fees. That's the promise, and it's also seen as really important for keeping the US dollar as the world's main currency.
Now, as we're talking about innovation, it's really important to point out that the technology is also fixing its own flaws. One of the loudest criticisms of crypto for years has been its massive energy use. But check this out. In 2022, the Ethereum network, the second biggest blockchain, went through a massive upgrade called the merge. The result? It cut its energy consumption by over 99.9%. That's a powerful example of how quickly this industry can evolve.
All right, let's pull back for the big picture here. We've gone over the tech, the problems, the proposed solutions, but why does any of this matter to everyone, even if you've never bought a single Satoshi in your life?
Well, it's important to get that this is about way more than just regulating a niche asset. It's really about three core things: protecting everyday consumers from fraud and collapses, fighting illicit finance to keep our whole system secure, and this is a big one, making sure that the United States stays at the front of the pack, leading the next generation of finance.
And this quote from the report itself, it just perfectly sums up their global ambition. The goal isn't just to make rules for America, it's to set a global gold standard for responsible innovation. The idea is, by creating a credible, robust framework, the US can attract the legitimate companies and discourage a race to the bottom, where projects just flee to countries with weak or basically non-existent rules.
Which leaves us with the ultimate question. The digital frontier is here, it's not going anywhere, and the effort to tame it is officially underway. But the central challenge is still there. Can the US actually strike the right balance? Can it build a regulatory structure that protects people and keeps the system stable without crushing the very innovation that makes this technology so revolutionary in the first place? That right there is the billion-dollar question that's going to define the future of finance.